Good morning and welcome to the Matthews Q4 Market Update. My name is Kyle Matthews, CEO and founder of Matthews. And over the next half hour, we'll be diving into the key economic and capital markets trends shaping the commercial real estate landscape. Got my camera here, I got my slides here, so I'll do my best to talk to you, not at you. But let's just go ahead and dive right in, okay? So, first slide, I got an agenda, and today we're going to begin with the big picture of where commercial real estate market stands right now and where the economy stands as we head into the closing months of 2025. Once we understand where we're at and why, we're going to tackle critical questions. Why bond yields have been so stubborn, even as inflation has cooled and rate cuts are finally underway. Finally, we're going to share with you our market outlook and what it means for your strategy as an agent or an investor moving forward. All right. So we're going to do it in, I think we got five parts, Zach. So 5 parts. We're going to go part one right now. All right. So let's just jump right in. We're going to start with a snapshot of the current market where we're at today. We're going to start with multifamily. The biggest talking point for apartment operators over the last 2 years has been the massive wave of construction taking place. While we do have a shortage of housing in this country, markets don't absorb units immediately. And so the timing of interest rate hikes with the supply wave put certain owners in a very tight situation. And so, as you can see on this graphic, the pipeline is thinning to its lowest level in nearly a decade. We're already seeing the impact of this slowdown in the performance numbers and the operating fundamentals of multifamily. On the left side of this slide, you can see net absorption has stayed strong this year despite the slowdown in the new units. And this has helped bring the vacancy rate in major metros back below 5%. It's also driving rent growth back up from the flat pace we recorded in 2024. Um, let's move on to retail. All right. Let's look at this cycle's darling, my favorite. I was a retail guy back in the day. I always say retail is having its moment in the sun. After 15 years, what was it, 2009 to 2000, early 2020s, retail finally seems to be enjoying its moment, as I said. So we're going to dive it. We're going to talk about retail vacancy. Okay. Despite the turn in absorption, overall retail performance continues to remain very strong. Now, too often people see a rise in vacancy or a loosening of the market and they don't consider the context. The reality is the retail market has been incredibly tight since about 2020. New construction barely exists and competition for leasing quality space is sky high. So a lift from 4 to 4.3%, it really, in my opinion, likely represents tenant reorganization out of underperforming locations, and a slight uptick in vacancy should allow for more value add deals to hit the market. Um, if you look at vacancy by center type, however, you can see the kind of space tenants are looking for. So big box spaces like malls and neighborhood centers continues to see more vacancy than the smaller, more compact spaces you're going to see in the SCNL, single tenant net lease, and the strip center space. If you look at the long term trend here, only malls are really recording more vacancy than they did a decade ago. Strip center vacancy, however, has fallen from 8.1% to 5%, which is a material move down. Again, it's a great time to be in multi-tenant retail, which again, after a long period, I love a very frustrating period. It's been a really fun ride the last couple of years. So moving on, we're going to jump right into industrial. The story here is really a battle between long-term trends and short-term realities. Construction of large-scale industrial sites, it rose rapidly after COVID, and as many investors saw, the pandemic saw it as an accelerant of e-commerce. The global supply chain was damaged, reshoring felt tangible as a result. None of these takes were wrong, but they take time to fully go into effect. So this rise in industrial vacancy you can see on the screen, it's a result of these long-term bets. Overall, this trend will reverse. E-commerce will continue growing, but the short-term impact is a down market for industrial leasing, especially for large-scale sites aimed at global tenants. The rent trends, as you can see on this slide, it reinforces this. So rent growth for industrial assets, it's at the lowest level in over a decade. It's kind of tracking with leasing volume. And this is another trend we also expect to reverse over the next 12 months. Firms have reacted to the tariff announcements, Liberation Day, and they're kind of taking a wait and see approach. And so as we move into 2026, companies will, in my opinion, start reevaluating their strategies. All right, now we're going to just move on to part two, right? Where we are today. Moving on to the heart of my business is brokerage, right? Transaction trends. And so um, you're looking at a slide, the slide's titled, "The Fed raised rates too late and cut rates too early." So to set the stage, let's look at how we got here. All right. This slide shows the aggressive rate hike cycle the Fed undertook to combat soaring inflation, no argument there. And you can see that while inflation has come down from its highs, the Fed funds rate remains elevated between 4 and 4.25. We've been saying this in the industry for almost a year, but the rate path, both on the way up and on the way down, in my humble opinion, could have been handled far better than it was. Um, we shaded in these. We have two shaded parts of this slide, about a 10-month lag. And when they were defining inflation as transitory, we felt they were about 10 months too late to start raising. You could see the black line started shooting up dramatically in early to mid 2021, and they didn't really start raising rates till 2022. And then again, opinion, I feel like most people would probably agree. They also maybe waited a little too long to cut, about 14 months lag from a higher for longer before they started rate cutting. So again, it's easy to be a Monday morning quarterback, and hindsight's always 2020. But they were a little late on the way up, a little late on the way down. So how has that affected our industry? Right, you see a slide here. This is data from Real Capital Analytics. It clearly shows the inverse relationship between the 10-year Treasury yield, the most popular benchmark for lending, and transaction volume. As the 10-year shot up, commercial real estate dollar volume on an annual basis, or in this case, quarterly basis, plummeted. This is the market lockup we've all been experiencing. It's been driven by a high cost of capital, and that makes new deals challenging to finance. We're really, and again, highlighted section here, we're really 11 quarters into a historically low volume. Many of these quarters had volume comparable to the depths of COVID, and we haven't seen volume this low really since, and it's not on this graph, 2012, 2013. So unsurprisingly, as we move on to this graph, asset pricing, this slowdown has impacted asset pricing. So this chart shows the change in the commercial property price index. So while asset values are generally down, the story differs by sector. Multifamily has seen significant corrections. However, the retail and industrial sectors have been proven to be far more resilient, likely for some of the data and the operating fundamental strengths that we talked about on a couple slides ago. And so pricing's held relatively firm in retail and industrial. And it really underscores the importance of a sector specific strategy in today's market. So, um, given commercial real estate's long term nature as an investment, the farther back you go, the better these valuations look. Your 2015 buyers aren't the ones facing tough lease renewals or foreclosure pressures, even if they have a refinancing, a forced capital market event like a refinance. The value of their asset is appreciated so much, if not pay down a lot of the equity, that refinancing for them, it really isn't a challenge. It's really those like 2022 buyers that use short-term debt or variable debt, and they're running into trouble. Not just because they had a big loan to value day one and there hasn't been much time since, but also asset values have come down. So whenever whenever we show that pricing graph, I think it's also important. It's an also important slide to show after. Commercial real estate isn't all about asset values. It can also be the best investment one can make to generate cash flow. And if you compare the average cap rates to the cash flow generated by, and again, on this slide, we took a couple different investment options. We took equity, stocks, US bonds, international bonds. You can quickly see the continued appeal of our industry. So if you want an investment that gives you both long-term appreciation potential and stable monthly returns, again, I'm a real estate guy. I know I'm biased. And just because I say something that's in my best interest doesn't mean it's not true. Commercial real estate is still the best option you can choose. All right, moving on. We're going to go into part three, which is the economic landscape. All right. That's the picture in the commercial real estate market. A slowdown, you can see in this picture, slowdown driven by higher rates, but the future of those rates, it really depends on the broader economy. So as we turn our attention in terms of we're going to turn our attention now into the economic landscape. You see that the labor market is getting back to realignment. I think that's the title of this slide. And we're finally starting to see the realignment that, again, in our opinion, the Fed's been looking for. The chart on the left, it shows job openings per unemployed person. That's returning to a more normal balanced level. We just recently saw, you could see it there, the unemployed workers for the first time in a very long time, really since COVID, crossed higher than the number of job openings, down from an unbelievable, never before seen a gap of 6 million more jobs than workers. That shortage was just a few years ago. And as you can imagine, as that gap shrunk, we also, at the same time, on the right side of the slide, the graph, we're starting to see average hourly earnings on the right moderating. This is precisely what the Fed has communicated they need to see to feel confident that inflation is under control. Furthermore, we are seeing job growth is slowing. We see further evidence of this cooling trend here. This Bureau of Labor Statistics data shows that monthly job growth is slowing down from its previously unsustainable pace, if you ask me. You add on to this that the massive yearly revision that the BLS announced maybe a month or two ago, and it's clear, again, from where we can see, it's clear the labor market is at best case scenario, a neutral level. So another slide we threw in here is, just leading companies, some of the larger companies that have announced layoffs in 2025. It's not, this softening in the labor market's not ending anytime soon as well. So major layoffs are happening at major bellwether companies. Okay, UPS, Dell, Intel, Microsoft. They've all announced significant workforce reductions this year. Companies are adjusting their strategies, but, looking at overall economic growth, as you can see on this slide, the picture has been a little bumpy. So after a soft first quarter, I mean, we had a negative GDP print, and some of that had to do, especially towards the end of Q1, concern about the pending, again, what eventually became known as a Liberation Day and the tariff threat. Q2 growth came in way above expectations, right? And that's fueled the likelihood of a soft landing versus a recession. And the Atlanta Fed's forecast, we're filming this, what is today? It's mid-October. Atlanta Fed's forecast is for Q3 is a very positive 3.8% annually. So to summarize the economic picture, if I may, labor market is returning to sustainable balance. Both job and wage growth are slowing but remain positive. Layoffs are moderating. Concerns about over and what the concerns about overheating economy and overall growth has cooled from post-pandemic highs. So all of these trends, in my opinion, strongly support the case for uh, impending interest rates cuts. But, right, nothing matters before the but. So, part four, what is going on with long term yields? So, long term bond yields, as we all know, painfully have remained stubbornly high. All right. It's created a major hurdle for the market, certainly in the brokerage industry, borrowing, cap rates, all of it. So, what is really going on with yields? I just put up a slide. Inflation and the Fed funds have come down, but the 10-year remains elevated. It brings us to the central puzzle for investors today. Inflation in the dark blue line, it's dropped significantly. So Fed funds rate in the light blue line, it generally historically is kind of expected to correlate and follow, in many ways track. And yet the 10-year treasury yield, which historically dictates commercial real estate lending rates, it remains elevated. And so understanding this disconnect is key to understanding the timing of a market recovery. So let's talk about what is keeping that 10-year yield so high. Um, Here you go. The answer starts with the federal budget. For over 20 years, the government has been spending more money than it brings in. This creates large deficits. Everywhere on this graph, we're spending higher than the income represents, except maybe early 2000, I think it is. So to fund this shortfall, the Treasury must constantly issue new debt. And to attract more and more buyers for this massive amount of new debt, the government must offer higher yields. Very simple. And that pulls all the other long-term rates up with it. It's a supply and demand in the bond market, just like any other market. And the scale of our national debt has now reached $36 trillion. That's 118% of our GDP. That means if every company and every worker paid 100% taxes for an entire year, we still wouldn't erase our national debt. That doesn't sound good to me. So you can see that historically, up until let's call it 2002, you can see that historically bond yields rose in tandem with the national debt. There was, again, getting back to strong correlation. But before, and respectfully, and then ultimately during the GFC, the global financial crisis, that relationship really became untethered. It broke. Debt continued to soar, but interest rates fell and stayed low. What broke this relationship? QE, quantitative easing. That was that was the force we called QE. This chart shows the Fed's assets, which ballooned when they began creating money to buy government bonds. By becoming the largest buyer in the market, the Fed created immense artificial demand, and that kept bond yields artificially low despite skyrocketing debt. Now, the Fed is engaged in quantitative tightening right now, or QT, removing that support and allowing yields to rise to a higher level. But it hasn't been on scale with the amount of QE that went in before. So let's do a little key takeaway of part four, sort of recap, crucial point. Bond yields are driven by a mix of pressures. There's the Fed funds rate for short-term borrowing, there are economic expectations for growth and inflation, and critically, there's supply and demand in the bond market, which is now dominated by massive government debt and the absence of QE. The bottom line is this: even when the Fed starts cutting short-term rates, the sheer size of our national debt will continue to put upward pressure on long-term rates matter most to our industry. And that takes us to part five, our last part, which I'll just call general market outlook. All right. Understanding these pressures on long-term rates is critical. Now that we have that foundation, we're going to pull it all together and look forward with our market outlook for the next 6 to 12 months. But before we do that, I am going to look back. I wanted to pull up a slide real quick. We added this last second. So here are actually some predictions I made on our kickoff call to at Matthews. At the beginning of this year, I made 5 predictions for the year. The first one predicted Fed will cut at least 75 basis points. We're at 25. It appears that we probably have another 50 basis points heading our way. So far, I look to be correct there. I predicted the 10-year treasury would end the year between 4 and 4.25. Again, check mark so far, though I actually might miss this uh, and I might be over. It might actually end up with a 3 handle in front of it. But again, so far tracking. Um, the third bullet point, the third prediction, we felt cap rates would continue to increase, but the pace of increase, the pace of values coming down would very much moderate, if not generally cease. And 25 to 50 basis point, what we've seen internally and what we've seen from market reports were very close. And again, earlier, the first half of the year, we did see cap rates rise 25, 50 basis points. And over Q3, we've seen it generally be flat. So again, I think we're going to be correct here. The fourth one, we felt debt would get cheaper on average. I know that's a pretty general prediction, but between construction, bridge, and 5, 7, and 10, it's pretty close. We have seen, again, the indexes come in a little, but we've also seen the spreads come in a little. So 50 to 75 basis points were right there. The last one, which I probably was most confident about, is the one it looks like we're going to miss. I predicted that transaction velocity would increase 25%. Even then, if I remember, I was pretty conservative. I thought it'd be more than that. And through the Q3, again, if I'm going to quote MSCI's Real Capital Analytics, I think transaction velocity is up roughly 10%. We're up at Matthews, we're up north of 40, so it's been great for us. But generally speaking, as an industry, it's still been a very challenging year for velocity, anemic growth. On 24 numbers, which had anemic growth from 23 numbers. So just again, getting back to that slide I showed you earlier, 11, almost 12 quarters into a very challenging capital markets experience. But again, I do think there's brighter days ahead. So um, here's some additional predictions. Experts predict that I think according to the CME Fed Watch tool, the market expects the Fed to begin cutting rates soon. Markets pricing in about 4 quarter point cuts over the next 12 months. So that should be good for us. This growing consensus on, kind of lower short-term rates is the first piece of good news for the market in a while. Again, there have been, outside of my predictions, there's been multiple moments where we thought the market was going to rip back and it hasn't happened. So I'm managing my expectations this time. Also, QT is slowing, and that's a big one. We touched earlier on QE and what that meant for the Fed's balance sheet and what it did for artificially suppressing rates, creating artificial demand for treasuries. Well, over the last 2.5 years, they've been doing that in reverse, again, quantitative tightening. So shrinking their balance sheet. And this is, we can see that QT is slowing down. They've really tapered it. I think it's roughly $5 billion a month now. This has sparked speculation about whether the Fed may be forced to pivot back to another round of QE. And why would they do that? In my opinion, it would be to prevent long-term rates from really shooting north of 5, and that would stifle the economy. And while it is controversial, QE, especially you look at over the last 15 years, it has historically been a very, very powerful stimulant for financial markets. So, talk of QE should be something that commercial real estate industry professionals track very closely in the months ahead. Here's a slide. It's we're showing you the spreads between what average cap rates and kind of where borrowing at. The wider the spread, generally speaking, the more volume you're going to experience, the more activity in the market. You can see the yield spreads in the last 2 years have been really tight. So, what are we expecting at Matthews? Again, this is the main factor that holds deal flow back currently. Spread between lending costs and property returns. We're starting to see lenders again get cheaper and reduce the spreads they want to see. And again, we are seeing cap rates continue to move slightly up, but I feel like pricing is from going up or going down is generally moderating at this point. And we expect this spread to really start to open up as we close 25 and really work our way into 26, which again should lead to more transaction volume. Should lead to more borrowing volume. Rate cuts will help, and a slowing of QT will also help. So um, let's see. The next decade, this is an important point. We're all busy people. We're focused, we're always focused on whatever the task is in front of us. And right now in the industry, the task is in front of us. The task in front of us is navigating a challenging market. But if you take a step back and long-term economic trends, they point to bright future for those in our business in commercial real estate. And I don't mean just brokerage. I mean, as an investor, as a borrower, as a lender, as a broker, according to the Federal Reserve and I think it was the Census Bureau data, we are on the cusp, or actually in many ways already involved the single largest wealth transfer in human history. Over the next decade, an estimated $40 trillion will be passed from boomers to their heirs, and a substantial portion of that wealth is held in legacy commercial real estate. And whether it's because they don't want to own real estate, it's too management intensive, or they have a stepped up basis and they can sell and not have a taxable event. Um, all of these, all of these, kind of generational transfers, they almost historically always stimulate transaction velocity. And we've done studies as a nation on what happens when wealth is dispersed from one generation to the next. And majority of the time, families choose to transact holdings and receive liquidity. It's not just because stepped up basis and tax returns. Sometimes they don't want to own assets with the other people they've inherited property with. Either way, it's a massive boom in deal volume for agents that are laying the groundwork now and a reason to potentially list certain holdings before we see the results of what we'll coin the term the great liquidation that, in my opinion, will follow over the next 5 to 10 years as part of this wealth transfer. So, closing slide, just wanted to thank you. That concludes our presentation. I know I was talking fast, but again, I want to get you as much information and data as possible in a short amount of time. They do all types of studies, and nowadays people's attention span is shorter than ever. So I wanted to be quick, efficient, to the point, and most importantly, be valuable. We anticipate we'll do this every quarter moving forward. So hopefully we'll be back sometime in Q1 to basically recap 2025. But to stay up to date in the meantime, follow my socials, the podcast or newsletter. Links can be found in the description or in my bios. Again, I appreciate your time and thanks for tuning in.